So hello traders, good morning traders, good evening, good afternoon. It depends on which time zone you live. I have a nice opportunity today to have the session, at least the first 15 minutes of the session will be transmitted also to YouTube. So all the people who still don't have access to our daily trades, daily analysis, you can see what we are doing while we have our sessions. So maybe those who still don't have access will do it. Normally, we have two rooms. We have beginners room and advanced rooms. Every day we are transmitting 8 or even 9 hours per day on each room. Different experts are sharing their ideas, sharing with their knowledge. Beginners room is mainly for people who are just at the beginning of the trading journey, and we touch in the beginner's room a bit more theory, more basic things from which we know from trading. So I usually share in the beginner's room the ideas of my strategies. And the strategy which I'll share today is a strategy for working people. It's a strategy for people who don't have much time for trading, but they still would like to do it. Maybe partially like a hobby, not as a main occupation, but so I call this strategy after work strategy. Why it's an after work strategy? Because you can put some pending orders on your platform, which will be triggered later, will be triggered even while you are outdoors, when you are at work, when you are driving a car, or you are traveling, and you don't have access to your computer or even sometimes to internet. Even then, if price hits the level where you planned your trade, a broker will open that trade. That's the benefit of using pending orders. How? Of course, it's not that easy that you put a pending order and believe that it will work. It's also important to know where you will put this order, where you plan to open a trade, and this strategy which I'm showing you, Opos, will help you to find those areas. I'm using a special system to find those areas, and those areas where I put my pending orders are called supply and demand zones. Why those zones are created? Why we can rely on those zones, that they will help us to find a place to put an order. Well, the main idea is that market is driven by two forces, the buyers and sellers. When we see some kind of imbalance in those things, then market moves in favor of those who are stronger. And unlike the levels of support and resistance, which are created for many various reasons, they are very often created by buying or selling because of some news. The supply and demand zones are created because buying and selling transactions are made by large players such as banks and hedge funds. Big banks, institutions, financial institutions deal with really huge amounts of money, and they cannot execute the order at once. They have to divide it to smaller pieces. Why? Because if they would put too big order at once, if there's not enough, let's say that they want to buy something and there's not enough sellers, very quickly the price will go up, because the sellers will find an opportunity to sell at better price because there's a big interest from the buyers. And that's why if someone wants to buy or sell anyway, he divides it to small pieces, not to disturb the market. And that's why those zones are created. And for an example, why demand and supply are pushing the price. because always when there's imbalance, the price is moving. You remember those times when we had the pandemic, and during the pandemic, people were staying at home. There were really significant reduction in traveling. Demand for oil plummeted significantly. Since the production still remained at the same levels, inventories were growing, tanks were filled in 100%, and it was even difficult to sell any other production because there was at the moment overproduction. And it really, this demand, reduced demand with still high supply led to really sharp price declines. And the oil in 2020, April, the price of oil has fallen to few dollars per barrel. And then when the demand came back, when the demand started growing, also the price was growing. And a few, let's say, months later, let's say 1 year later, we saw a spike up. The oil costed $130 per barrel. And what's important, it's the same product, but look at the difference in price. Why? Because here the demand was very low, and here the demand was very high, because in February 2020, when the war started between Russia and Ukraine, Europe was afraid that there will be a problem with delivery of oil to Europe, and that increased quickly demand. The country started filling their tanks. They were buying wherever they could only buy oil. And this made a huge growth of demand, and that's why price jumped up. So the same product, but the price depends on demand and supply. How it's on the charts? On the charts, we can see some areas where market is strongly buying or strongly selling, and those areas we call either supply or the demand zone. Of course, it depends how the price is moving from where the price started moving. And here you can see a strong area where market started strongly buying, pushing the price higher. And here we have area where market started selling. It's those areas we can say that this is an area of sellers. And here we have area of buyers. And why price, when hits it again, starts to grow? Probably because this company name, let's say A, started buying, but they were able to trigger only 50% of the orders. It means that they wanted to buy much more, but because the price quickly ran away, they only bought twice, and they completed 50% of the orders. And they are still eager to buy at this price. And when the price is again at the area which is interesting for them, they complete their orders, and they also complete another 50%. The same is with sellers. The sellers who started selling here, because the price moved very quickly, they were not able to open all the orders. They, let's say, opened only 50% of the orders, and they are waiting still with some orders here. And if any day the price comes back, it will be probably selling also. So another part of the orders will be opened. That's how the supply and demand zones work. I'm using an indicator which is helping me to draw those zones, because drawing those zones manually is of course possible, but it takes a lot of time, and it's a bit annoying to find that if you change the time frame, you find different supply and demand zones. So I have a indicator which is called supply demand. It's called sub dem. And this indicator added to the platform gives you those areas. It's very, very helpful tool because you can use it also not only when you are planning pending orders. For example, you put a sell limit here, expecting that when price hits that supply zone, there will be a pullback. Or you can put also a sell stop, which means that a zone which was already twice used might be empty. Maybe there are no orders here. So in case they break it, you will have a trade opened down. You'll have a trade down. And this one is that you will trade on a reflection. So you have many possibilities to use those zones, but you can also use them as targets for your open trades. For an example, if you open a sell here, you should put your target above the closest demand zone, because putting a target lower means that you are ready to see something like this, or maybe like this, and it takes time before they reach your target. So why should you lose those pips? You just close it here, and you can enter later again when price makes a correction. So those zones can be used not only as an entry areas, but also as take profits, and also like stop losses, because if you sell here, you target this one, but you put your stop loss above the demand zone, because it means that if price will return and it will go higher, it means that the buyers came back to this area. You can also use this strategy in a way, I call it a straddle strategy. You can use it when you're expecting some important news. You check the economic calendar and you find, oh, there are some news. For an example, the Reserve Bank of Australia will decide about interest rates. So usually when the decision comes, market is moving rapidly in one direction, either up, either down. We don't know which. So if you see that before the decision, before we see the numbers, market is in a narrow consolidation, it could be a good idea to put a buy stop over this consolidation and sell stop below. And then when the news are released, you can see market is moving. It will trigger your open order and give you some quick pips. So generally, this strategy is very simple, because the only thing you need is use the indicator, which is drawing those zones, and find the areas where is the best moment to open a trade. Here are some tips which you can use, which you should know while you want to use this strategy. But remember, those are some tips which is best thing is to read them and check it on the charts, on the live charts. And remember, very important, if you open a pending order, you must put a stop loss and take profit, because market might move violently. Well, if you don't have a stop loss or take profit, it can make you either give you big losses, or even if it's initially would give you, let's say, 20, 30 pips profit, then market reverses. And if you wouldn't have the take profit, you will have no profits. Okay, now we can go to the chart and I'll show you how it looks in practice. Those are the zones which I mentioned, the supply and demand zones. And you can see that on different time frames, you will find different zones. That's why if you stick to one time frame, you should only put trades on that time frame. And here's a very nice sample how the zones work in long term. A zone was created here. It was created in December 2024. And look that after 4 months, they come to this area and again we have a strong reaction. What does it mean? It means that someone who started buying here, because the price ran away so quickly, there were,